Henry is 65 years old. It's 6:14 in the morning. He's in his kitchen in Columbus, Ohio. CMC on low, phone face up on the table. He's watching the number, not because he wants to, because he can't stop. He has $1.25 million saved. Contributed every year since he was 27, never touched his retirement account, never tried to time the market. He did everything right, and he cannot sleep past 5. 45 minutes away, a different version of Henry is making eggs. He glanced at his phone once this morning. Put it down, he's fine. And a third version of Henry, he's at a small restaurant outside Florence, Italy. The espresso is good. He has no idea what the market did yesterday. He doesn't need to. 3 men, same name, same work ethic, same starting salary, different retirement account sizes by exactly the amounts I'm going to show you today. Now here's the thing about these 3 men. None of them got lucky. None of them hit a hot stock at the right time. The gap between Henry A watching CNBC at 6 in the morning and Henry C in Florence not thinking about it at all, it comes down to one number, a calculable specific number, actually 3 numbers. A JP Morgan study tracked 20 years of investor behavior and found that the average retail investor earned 2.9% per year. The S&P 500 returned over 10% per year over the same period. The average investor earned less than a third of what the market returned. The entire gap, every dollar of it, is not explained by bad stock picks, not by bad timing. It comes down to one moment that repeats across millions of accounts, in every correction, every downturn, every time the market turns red. Roughly 40% of retail investors sell, not rebalance, not adjust. Sell when the market drops 5% or more. They lock in the loss. They guarantee the worst outcome. Then they sit on the sidelines until prices recover and buy back in higher. This is not a knowledge problem. Every one of those investors knew on some level that they should hold. They'd read the articles, some of them had the spreadsheets, they understood the math, and they still sold. This is a threshold problem. And threshold problems have specific calculable solutions. That's what this video is about. Now, in a few minutes, I'm going to show you the single most dangerous 5-year window in a person's financial life. A window that has wiped out disciplined savers who did everything right. But first, I want to plant a story in the back of your mind. 2 brothers, same savings discipline, same portfolio size at their peak, completely different retirements. Not because of anything either of them did. I'll come back to them near the end, because what happened to those 2 men is the clearest illustration of everything I'm about to explain. Hold that in the back of your mind, the 4% rule. In 1994, a financial planner named William Bengen published research in the Journal of Financial Planning. He analyzed US market data going back to 1926, Great Depression included, and found that over any 30-year rolling period, retirees who withdrew 4% of their initial portfolio, then adjusted that dollar amount for inflation each year, never ran out of money. It held across every historical scenario, every crash, every recession, every bear market in a century of data. The shorthand became save 25 times your annual expenses and you're done. The problem is what nobody told you about what done actually feels like. Picture this. You need to cross the Atlantic Ocean. You're in a fishing boat, 12 meters, single engine, modest fuel tank. You've done the math, exactly enough fuel to make it, engine recently serviced. Weather looks acceptable. Statistically, you probably survive. Now tell me honestly, are you relaxed? You are not relaxed. Every wave is information. Every shift in wind is a calculation. You're running fuel estimates in your head every few hours because you are at the minimum viable threshold. You are not safe. You are just probably okay. And probably okay is not the psychological state most people imagined when they spent 30 years saving money. This is exactly where the 4% rule leaves people. They hit 25 times expenses, the officially sanctioned, research-backed retirement number. And they discover they are still checking their portfolio 3 times a day, still losing sleep when the market drops 8%. They assume this is a character flaw, that they need to meditate more. Worry less. Trust the math. It is not a character flaw. The math is the problem. Here's why, and this is the part that changes everything. Research by Wade Pfau estimates that approximately 77% of a portfolio's final retirement outcome is determined by the returns of just the first 10 years of retirement. 77%. 30 years of patient, disciplined saving, mathematically less important than the decade that immediately follows the day you stop working. This is called sequence of returns risk. And it is the reason some people retire with exactly the right number and still end up broke. Here's how it works. When you sell investments during a downturn to cover living expenses, those shares are gone. Not temporarily down, gone. They don't participate in the recovery. During your working years, the order of returns doesn't matter much. A 20% loss followed by a 25% gain produces roughly the same result as the reverse because you're not pulling money out. But once withdrawals begin, early losses compound in a way that later gains cannot undo. A 20% decline on a $1 million portfolio costs $200,000. The same 20% decline on a $400,000 portfolio costs $80,000. Same percentage, vastly different damage. And when you're retired, you're withdrawing on top of that damage. The base shrinks. The recovery has to start from a lower floor and carry more weight. And you're still pulling money out while it tries to climb back. Morningstar's 2026 State of Retirement Income Research confirmed it directly. Retirees who hit poor returns in the first 5 years and didn't adjust their spending were far more likely to exhaust their savings than those who came through those early years in positive markets. That's the trap. You do everything right. 30 years of saving. You hit the number. You quit, and then the market has a bad first year. And you're selling shares to pay rent at the worst possible moment. Those shares don't come back, and neither does the retirement you planned. Before I show you the 3 levels, I want to introduce you to someone. Marcus is 48, project manager at a mid-sized company in Columbus, makes $95,000 a year. Household expenses around $72,000. Mortgage, 2 kids in high school, normal life. He's saved $390,000. According to the Federal Reserve's Survey of Consumer Finances, Americans in their 40s have a median retirement balance of around $220,000. Marcus is ahead of most people his age, significantly ahead, and Marcus checks his phone every time the market turns red. After the correction in early 2025, he told his wife he was thinking about moving everything to bonds. Marcus isn't behind, Marcus is at the wrong threshold, and he doesn't know it yet. We'll come back to him. Now, the 3 levels. Level 1, the survival line, 25 times your annual expenses, 4% withdrawal rate. This is where Henry A. lives. This is why he's in his kitchen at 6:14, phone face up, watching the number. Annual spending of $50,000. Survival line is $1,250,000. $70,000 a year, $1,750,000. $100,000 a year, $2.5 million. Here's a number worth sitting with. The amount most Americans say they need to retire comfortably in 2026, according to a Northwestern Mutual survey, is $1.46 million, up $200,000 from the year before. $1.46 million is the survival line for someone spending about $58,000 a year. It is the fishing boat. And here's what the fishing boat actually feels like to own. Research on loss aversion, the work of Kahneman and Tversky, which earned Kahneman the Nobel Prize in Economics in 2002, found that losses feel roughly twice as painful as equivalent gains feel pleasurable. The market is positive about 3 out of every 4 calendar years, up slightly more than half of all trading days. But if losses hit twice as hard as gains feel good, the average investor experiences the market as though it's down most of the time, even when it isn't. Your cortisol doesn't read the long-term chart. At the survival threshold, a 30% market crash pushes your effective withdrawal rate from 4% to 5.7%. That's outside the safety zone. The boat is taking on water. And here's the thing that almost no retirement advice gets right. The anxiety at this level is not irrational. It is completely proportionate to the actual math. The danger is real, which means the solution is not a better attitude, not a mindset shift, not learning to trust the process. The solution is a bigger boat. One more number. The median retirement savings for all American families is $87,000. Not average, median. The number most Americans think they need is $1.46 million. The gap between where people actually are and where they think they need to be is already enormous. But the part I want you to hear, $1.46 million is still the fishing boat. Level 2, the calm line, 30 times your annual expenses, 3.3% withdrawal rate. This is where Henry B. lives. This is why he eats breakfast without checking his phone. Here's what 30 times expenses actually does. The 3 worst crashes in the last 25 years. The dot-com bust, down 49% peak to trough. The 2008 financial crisis, down 56%. COVID, down 34%. Take a severe 30% crash, one of the worst in modern history. It reduces a 30 times expenses portfolio to roughly 21 times expenses. Your effective withdrawal rate moves from 3.3% to 4.7%. 4.7% is exactly what Bengen's updated 2025 research says some retirees can safely withdraw even in worst-case scenarios. You're at the edge, not past it. The boat is rocking. You can see it rocking. It is not sinking. Here's the practical difference that makes the calm line actually feel different. At 30 times expenses, you have roughly 6 to 12 months of extra portfolio value available as a cash buffer before you ever need to sell equity in a down market. You're not selling shares to pay rent. You're waiting. And waiting is free. Every single market drawdown in modern history was followed by a full recovery and new all-time highs. COVID crash recovered in 5 months. 2008 took about 4 years. Dot-com bust took about 7 years. Patience was rewarded every time. No exceptions. Let me put the calm line into dollar terms. Annual spending of $50,000. Survival line $1,250,000. Calm line $1,500,000. The gap is $250,000. At a reasonable savings rate with a low-cost index strategy, that's roughly 2 to 4 additional years of work. 2 to 4 years of work. That is the full price of sleeping through corrections. Annual spending of $70,000, survival line $1,750,000, calm line $2,100,000, gap $350,000, annual spending of $100,000, survival line $2,500,000, calm line $3 million, gap $500,000. Level 3, the indifference line, 40 times your annual expenses, 2.5% withdrawal rate. This is where Henry C. lives. Florence, good espresso. No idea what the market did yesterday. Here's why this level is different in kind, not just in degree. The S&P 500 averaged 10.4% annually from January 1996 through December 2025, adjusted for inflation, roughly 7% real. At a 2.5% withdrawal rate, you are withdrawing less than half your portfolio's real long-run average return. In most historical scenarios, your portfolio is growing faster than you are spending it. Consider the absolute worst case. A 50% crash, the worst single decline in modern history, pushes your effective withdrawal rate to 5%. Still within Bengen's updated upper bound. The 3 worst bear markets of the modern era, 2008 down 56.8%, .com down 49.1%, COVID down 33.9%. Not one of them would break a 40 times expenses portfolio at a 2.5% withdrawal rate. The math says you're fine, and eventually your nervous system agrees. But here's something about the indifference line that isn't in the math. At 40 times expenses, your money isn't just a retirement fund. It's a buffer between you and the worst version of yourself as an investor. When Henry C. doesn't check his portfolio in Florence, he's not exercising some rare form of discipline, he just doesn't have to make that call. The moment of panic never finds him. The real wealth isn't the number in the account, it's the number of times you don't open the app. Now the dollar numbers for level 3, because the framework only works if you can put your own numbers into it. Annual spending of $50,000, calm line $1,500,000, indifference line $2 million. The gap from calm to indifference, $500,000. Annual spending of $70,000, calm line $2 million, $100,000, indifference line $2,800,000, gap $700,000. Annual spending of $100,000, calm line $3 million, indifference line $4 million, gap $1 million. These are not small numbers, but they are calculable ones. And a calculable problem is a solvable problem. Now, the thing that makes most people genuinely furious when they finally do this math. Here's what's actually costing a lot of people their threshold. Not a market crash, not a bad decade of returns, a number on a quarterly fee statement that most people have never read closely. For many investors, the fee isn't just costing them money, it is costing them a threshold. It is the distance between Henry A and Henry B being paid to someone else every year, quietly in the background while the quarterly statement goes unread. A 1% annual advisory fee, compounded over 30 years, can reduce your portfolio's final value by roughly 28%. For a $2 million portfolio earning 7% annually, that 1% fee could represent over $566,000 in lost wealth over 30 years. Here's a cleaner version of that number. A $1 million portfolio growing at 7% with no fees reaches roughly $1,967,000 in 10 years. At a 1% annual advisory fee, that drops to about $1,779,000, a $188,000 difference in a single decade on a $1 million starting balance. Here's the reframe that makes this number real. At a 4% withdrawal rate, a 1% advisory fee is 25 cents out of every dollar you withdraw. Not to your rent, not to your groceries, to the fee. A 1% difference in fees can mean 5 to 7 additional years of work. Not because of a crash, not because of bad luck. A quarterly statement, it's only 1%. You'll hear that from advisors delivered calmly while they show you a pie chart. An advisor once told a friend of mine, and this story is almost too clean to be real, but it is, the market is very complicated right now, he said. I wouldn't make any major moves. That year, the market was up 14%. It wasn't complicated. It was just up. Just a Tuesday. The complication was invented to justify the relationship. Over the last decade, fewer than 7% of professional money managers, people whose entire job is to beat the market, actually beat the index over 10 years. And they charge 1 to 2% annually for the privilege of statistically underperforming. The retail investor who holds a total market index fund and doesn't sell during corrections is statistically more likely to outperform 93% of professional managers over a decade. That is not a small edge. That is the whole game. The boring portfolio beats the exciting one. Not occasionally, consistently now. Remember Marcus? Marcus, 48, $390,000. 72,000 a year in expenses. Survival line, 1,800,000. Calm line, 2,160,000. Indifference line, 2,880,000. He is $1,770,000 from the calm line. Here's what Marcus is doing right now that's working against him. He's paying a 1.1% advisory fee on his $390,000. That's roughly $4,290 a year, extracted from his compounding base every year before returns. His advisor has him in moderately active mutual funds with an average expense ratio of about 0.5%. Combined fee load, 1.6% annually. A 1% difference in fees can reduce a final portfolio value by 20 to 30% over 30 years. At 1.6% combined, Marcus is likely giving up something closer to 35% of his final portfolio compared to a 0.1% index strategy. Over 20 years, the difference between 1.6% and 0.1% on a growing portfolio could be $200,000 to $400,000. At $72,000 in annual expenses, that's between 3 and 6 years of retirement income. Marcus may be paying fees that are pushing his arrival at the calm line back by 3 to 4 years. Not a crash, not a black swan, a fee statement. If Marcus moved to a total market index fund today, 0.07% expense ratio, no advisory fee, kept his savings rate, and just didn't sell during corrections, the math says he could reach the calm line about 3 years earlier. He doesn't need to get clever. He needs to get boring. Now let me tell you about the two brothers, because this is the story that makes the sequence risk math stop being theoretical. David retired in late 2006, 55 years old, $800,000 saved, annual expenses of $40,000. That put him at 20 times expenses, below even the survival line. He didn't know that framework existed. He figured $800,000 was enough cushion. In 2008, the market fell 38.49%. David's $800,000 became approximately $480,000. He was still withdrawing $40,000 a year to live, selling shares at the bottom, watching his principal shrink in real time while his expenses stayed exactly the same. By 2010, David went back to work, not because the market failed him permanently. After 2008, the market returned 23.45% in 2009, then kept climbing for 6 consecutive years. David went back to work because the sequence hit him at the worst possible moment and his portfolio couldn't carry the withdrawal load through the trough. His brother Paul retired in early 2009, same discipline, same habits. Paul's $800,000 had actually fallen to around $500,000 by the time he retired, less than David's starting number. He walked in with less. But Paul walked in at the beginning of one of the longest bull runs in market history. He never had to sell shares at a depressed price. His portfolio grew before he had to lean on it. He's comfortable today. Same savings discipline, same portfolio size at peak. Completely different outcomes. Not because of investment skill, because of the calendar. This is what sequence risk actually looks like when it reaches a real person's life. And it is why the calm line, its buffer, its lower withdrawal rate, its extra room, is not optional. It is the structural difference between David's story and Paul's. Now, 3 things you can do immediately. First, stop using 25 times expenses as your finish line. Recalculate to 30 times your current annual spending. If you spend $60,000 a year, your real target is $1,800,000, not $1,500,000. And if your savings are mostly in pre-tax accounts, a traditional 401k or traditional IRA, add 15 to 20% for taxes. When you withdraw from those accounts, you owe ordinary income tax on the full amount. The gross withdrawal you need is higher than the net income you want. Run that math before you decide you've hit the number. Second, do the fee audit today, not next quarter, today. Open a blank spreadsheet. Find the advisory fee on your accounts if there is one. Find the expense ratio on every fund you hold. It's in the fund's prospectus and on any fund data website. Add them together. If the combined number is above 0.5% per year, you are paying for something that decades of data say doesn't pay for itself. The historical average annual return of the S&P 500 over 150 years is 9.434%. A 0.07% total market index fund keeps almost all of that. A 1.5% fee portfolio keeps roughly 8.5%. Over 20 years on a $500,000 portfolio, that difference is not a rounding error. It is a retirement milestone. Third, build your sequence of returns buffer before you cross the finish line. 18 to 24 months of living expenses in cash or short-term treasuries held completely separate from your equity portfolio. Not there to grow, there for one purpose, to make sure you never have to sell equity in a down year. Think of your savings in 3 buckets. The first covering 3 to 5 years of income in liquid, low volatility assets, giving your equity holdings time to recover without being touched. Average recovery time from a 5 to 10% drawdown, about 3 months. From a 10 to 20% correction, about 8 months. You're almost certainly through the worst of it within 2 years. Your equity portfolio recovers at full size, not the smaller size caused by selling at the bottom now. The 3 Henrys. Henry A didn't do anything wrong. 30 years of saving, hit the number every calculator and article told him to hit, built exactly the fishing boat he was told to build. He just didn't know what vessel he was actually in. Henry B crossed one threshold beyond that. For someone spending $50,000 a year, the gap between Henry A and Henry B is $250,000. 2 to 4 additional years of work. He eats breakfast now without checking his phone. The market corrects. He knows. He doesn't look. Henry C crossed the second threshold. Not smarter, not luckier. Same person, different number. Somewhere outside Florence this morning, the espresso was good and he ordered a second one. The market opened, moved, closed. He doesn't know which direction. It didn't come up. You now know the 3 lines. You know the math behind each one. You know exactly what it costs to cross from one to the next. The only question left is which one you're building toward and whether the path you're on is actually taking you there. If this changed how you think about the number you're aiming for, subscribe. The next video covers the exact savings rate you need to cross each of these thresholds before a specific age. The math is more forgiving than most people expect. I'll show you what it actually looks like.